Hello and welcome. You're watching Asset TV Masterclass with me, Jenny Hammond, today looking at ETFs. Well, ETFs are a $4 trillion market, and it's a market that's continuing to grow. So here today to discuss the trends and drivers shaping the industry is, to my right, Christine Cantrell, Sales Director, ETFs, BMO Global Asset Management, Pav Sharma, Associate Director, UK Sales and ETF Securities, and Deborah Furr, Managing Partner of ETF GI. Now, Deborah, I want to start with you, and I want to start with a quote by Jack Bogle, who's the founder of Vanguard. He said, "From a modest beginning, ETF's impact on stock trading has now reached mammoth proportions." Now, of course, that is in the United States. So how have you seen the rise here in the UK?
Yeah, we've definitely seen a significant increase of investors here in the UK and across Europe using ETFs. I think that the retail distribution review has caused people to learn more about ETFs, and we're increasingly seeing platforms and others embrace using them, creating model portfolios. And institutions have been an early adopter, where we've seen that many institutions are finding that in many cases, ETFs are a more cost-efficient tool to use to equitize cash than using futures. So you're finding that ETFs are being used for exposure to equities, fixed income, commodities, multi-asset class, and then within that you have the niches of smart beta and a number of new innovations that have come to market over the past few years. So it's been a pretty impressive growth. When we look at the growth in assets here, as well as globally, we're at record levels in every market except for just Latin America and the Middle East.
Yeah, and Christine, BMO Global Asset Management, that's been involved in ETFs for quite some time as well. So how have you seen the rise of ETFs?
Yeah, BMO Global Asset Management actually launched their first ETF in 2009 over in Canada, and more recently in Europe in November 2015. And the 8 years as well that I've been in the ETF industry, the biggest change that I've seen is actually the evolution of the user, kind of similar to what Deborah is saying, in that in the early days I would have experienced the majority of users were multi-asset UCITS fund managers, so those that really specialize in asset allocation, and they just wanted to use very easy, efficient tools to execute that. Whereas now I think more and more, especially here in the UK, and what we have seen originally in Canada, the private wealth channels really taking up a lot of ETFs in their portfolios. So that's kind of only a way to continue, I think, going forward, driving the growth.
And Pav, would you agree? And how have you seen trading strategies develop?
Yeah, absolutely. So the developments in the UK and Europe has been quite dramatic over the last 5 or 10 years. So one area of growth is smart beta ETFs. I think it's interesting to observe or explore both what smart beta ETFs are, but also why they're growing in popularity. So dealing with the what, essentially, they're rules-based passive strategies. But what they're doing, and this is important, is they're tracking alternatively weighted strategies or systematic factor-based strategies, and they're designed to sort of provide enhanced risk-adjusted returns and improved diversification in the long run. So many sort of advisors and wealth managers are looking at these products, smart beta products, and they see them as the best of both worlds. They use many of the macro and style factors that active managers use, but they incorporate this in a rules-based passive manner, importantly in a low-cost fashion as well. So it's providing a very neat solution for advisors to implement within their multi-asset portfolios.
Yeah. Well, Deborah, ETFs have seemed to get quite a bit of bad press over the years. So what would you say are the advantages of investing in them in today's environment?
I think there's quite a few advantages. I think one is that they're the only democratic product I know of. So if you think about the ability for most retail investors or financial advisors to invest in the same toolbox at the same annual cost, there's no other product. So they're very cost efficient, they're transparent, they allow you to get in or out of exposure whenever you feel it's important for you to do so. You can invest in very small sizes. And I think really a lot of the products are just plain vanilla building blocks. And so for many investors, when they look at, is it easy to find active funds that consistently deliver alpha, that proves to be a really big challenge. Because if you look at the studies, typically 7 out of 10 active managers don't beat their benchmark. And so if you're looking at investing outside of your home market, often you don't feel you have the skill and knowledge to do so yourself. And you often find it's hard to pick good active funds. And so quite often what you find is using ETFs to develop low-cost building blocks alpha can be generated through asset allocation. So it's not just about security selection. And so you find that, if you want to invest in the US or Europe, or if you want to invest in sectors or China A shares or gold, it's just a very easy way to do it. And if you think about gold, it's the only way to invest in gold bars, just like central banks own. Otherwise, you typically would end up buying products that are investing in gold mining securities, or you'd be buying gold that you'd stick under your mattress if you want the physical. So I think it really has been an innovation that has allowed all types of investors to understand the impact of cost on performance and to understand that asset allocation can deliver alpha. And to even contrast it to hedge funds, which most people would think, well, I'm going to get alpha if I invest in a hedge fund because they're really only for selective investors. A study we just published found that in the past 6 years, and in Q1 and Q2 this year, if you looked at asset-weighted returns of hedge funds, they have in each of those time periods been below the S&P 500. So you're paying very high fees and not getting the alpha you expect. And another interesting stat is the ETF industry now is $1 trillion larger than the global hedge fund industry. So that just happened at the end of June. So impressive to watch the growth, given ETFs are 27 years old and hedge funds are 67 years old.
So bearing that in mind, Pav, how can advisors use ETFs as part of their portfolio?
It's a good question. I mean, the beauty of ETFs are that they're incredibly flexible instruments. So they can be used in a number of different ways. So as has been sort of implied already, they can be used as core building blocks within portfolio construction. So we've seen many wealth managers use both equity, fixed income, commodity, even currency ETFs within the core strategic positions that they take in their portfolios. But interestingly also, we've seen an increase in tactical usage of ETFs within satellite positions. So many investors are looking at thematic types of investments, for example, robotics or cybersecurity, or they're also looking to trade around events. So Brexit in 2016 posed a lot of challenges for investment managers. And what we saw ETFs, different types of ETFs being used at different times, whether they're currency hedged ETFs or ETFs actually offering exposure to different types of asset classes like currencies. There's a great deal of flexibility in terms of how they can be used within multi-asset portfolio construction.
Yeah, and Christina, I can see you nodding along. How would you suggest advisors use it as part of a multi-asset portfolio?
Yeah, I'd agree with what Pav says, but another way to look at it is that you could choose to use 100% ETFs in your portfolio, but that's not the only way of going forward. You could also blend it with active funds, and we've seen that being quite successful, especially even just test running a lot of portfolios using, say, active managers for certain exposures and then ETFs for others, just to reduce the overall portfolio's cost. And then another way to look at it is whether you really want to limit the number of vehicles you use, you can still create a very diversified portfolio by only using 2 or 3 ETFs in it. Or you could choose to be very, very granular, and that might give you an extra edge, especially if you have a different type of knowledge set on particular sectors or regions.
So looking at asset allocation, is there a sort of a perfect mix that you think, the amount of ETFs?
Well, since, say, if you invested your majority of your portfolio in the low cost side of things using ETFs, that will reduce your overall cost base. So you could arguably say the more you have in ETFs, it'll benefit you on the cost side, and then you could choose the small parts of your portfolio using alpha generators.
And just to touch on that, where we've seen real development in ETF usage has been in the developed market, equities and fixed income markets. So markets that have been perceived to be quite efficient, where active managers can't necessarily provide above benchmark returns. But what we've seen is ETF usage in those specific areas grow very rapidly. But now what we're seeing more and more emerging markets where perhaps active managers aren't providing the alpha that many investors expect them to. In those markets too, we're seeing ETF usage pick up there as well.
Yeah. Well, one thing that is certain about today is there's a lot of political noise around, a lot of uncertainty, and in fact equities and bonds, Deborah, have been doing very well. But are there certain market conditions that you think that ETFs either thrive or in fact struggle?
Well, it is kind of funny because when volatility is up, people use ETFs a lot, and when there isn't a lot of volatility, you still see flows going in, just as you've heard as to why ETFs are being used. So I think what you tend to find is political and economic uncertainty will be reflected in the way we see ETFs being used. So when people were concerned about the direction the French election might be going, you saw money coming out of exposure to France. And then when the results were known, or even after the first referendum, you found that money was going back into the French market. Same with Brexit. We saw money coming out of both the UK and Europe because there was so much uncertainty as to what does Brexit mean. After the vote, we did see at least some level of certainty, and money has gone back into Europe. With the election in the US, the whole debate about Mexico and healthcare caused, depending on whether people thought Hillary or Trump was going to win, flows were going into one or the other sectors. So it is very interesting to watch the flows, but you do see that if investors are concerned, often they'll go to a safe haven like gold. And if they see performance being strong in emerging markets or benchmark changes like MSCI announcing that A-shares are going to move into mainstream indices, you'll see investors start to implement changes in their allocations.
Well, you've actually told me previously that ETFs are a good barometer of investor sentiment. So what's they telling us now?
So what they're telling us is, it's been amazing. We've had over 3 years of positive net inflows. So I don't know of any other product that could say that. And what we've seen is this year there's been record net inflows in the first half of this year. So $348 billion versus all of last year was $390. So we're going to have a record year this year in terms of flows. And what we've seen is equity markets have performed really well this year. And so many investors have been putting more money to work in the US. We've seen money going into emerging markets. We've seen some money going into fixed income. We've seen some going into gold, although the allocation was earlier in the year. So what you're seeing is that representation of where investors think there's either concerns or there's opportunities. And so I would say that this has been a very interesting year when you look at the allocation of money and the changes on a month-to-month basis based on those political and economic trends that we see in the market.
Well, this is a good time to bring up risk. So, Christine, what's your approach to risk?
Well, at BMO Global Asset Management, we are very conscious of clients' aversion to counterparty risk. So we were very confident in the fact that we wanted to physically replicate all of the equity portfolios that we run in ETF form. And in addition to that, we don't engage in any securities lending that might pose further counterparty risk. Another risk that some clients are concerned about is currency. So we have a lot of ETFs available that are sterling hedged, for example, so that they don't have to take overseas currency risk.
So talk me through your offering a little bit more then with this in mind.
Yeah, so actually it might be quite easy to summarize our whole range in being very focused on income-oriented solutions. So most recently, actually, we launched some enhanced income equity ETFs. So these are completely new to the UCITS ETF market, but we've been running very similar strategies in Canada since 2011. Essentially, all it is replicating the mainstream equity benchmarks like the FTSE 100 or the S&P 500, but actually adding an extra layer of options to generate about 3% yield to the client's portfolio. And that's one segment. We also have embarked on a dividend yielding strategy as well, since that's a very staple source of income as well. But having our active managers lens on, we decided to put a quality screen on that first. So whenever we look at dividend paying stocks, we want to make sure that they are high quality first. And then just lastly, on the fixed income range that we offer, we were very innovative in launching global corporate bonds for the first time, being segmented by maturity band. So that just allows for clients to, again, focus on income and as well manage their duration risk. I suppose it would be amiss just to neglect to mention that, especially when you're looking for higher income, we also have one of the lowest cost global high yield ETFs in the market as well.
And Pav, your ETF securities, tell me about those.
Absolutely. So most viewers will probably know us for our physical gold products. So our chairman at ETF Securities, Graham Tuckwell, invented the world's first physically backed gold exchange traded commodity. Commodities have very much been the core of our business. But it's interesting to look at how we've developed alongside how the ETF industry's developed, more broadly speaking. So in the equity side, we've really focused on thematic equities. So we've looked at themes like robotics and automation and cybersecurity, which have been very much in the news in 2016, 2017, we've seen huge investor flows in those areas. And of course, smart beta as well, which Christine's already touched on, is a huge focus for many ETF providers. We've specifically looked at fixed income. So we saw, some flaws in the market cap approach with, fixed income ETFs, but also the active managers benchmarked to those market cap indices. So what we did is we launched a range of fundamentally weighted fixed income products with Lombard Odier Investment Managers in 2015. And we're seeing this sort of fundamental approach really sort of gain a lot of traction. So we're seeing investor behavior in different asset classes move along with developments in the ETF industry, which I think from an ETF provider perspective is very interesting.
Yeah. And Deborah, there's obviously a lot of products out there and you have a view of the whole industry. So what are you seeing that's looking really promising at the moment?
I think what's looking promising is the fact that there's a lot of new channels of distribution. So we're seeing that, as was mentioned, private banks are embracing ETFs, online brokers are embracing ETFs, the platforms are increasingly embracing them, and we are finding that more institutions are using them. So it really is a product that's being used across the entire landscape, including and retail investors are using ETFs more. So I think that's interesting. And ETFs are expanding to new markets. I was just out in Kenya, which cross-listed a gold product. So ETFs are now available in over 56 countries around the world, which is pretty impressive to watch how the benefits are expanding, not just in developed countries, but to many emerging markets where they see how ETFs can help end investors.
And you mentioned earlier about how they could be used to generate alpha. So how could they be used as part of a portfolio, would you say, to generate alpha?
Yeah, so I think, to kind of play on what's already been said, what you tend to find is people like this barbell approach to investing. So if I feel I can add alpha myself by picking stocks, have a good hedge fund, good active manager, I use that on the one side. And where I feel I can't find that alpha, I will go to low-cost beta products like ETFs. And so what I've seen over the years is, sometimes managing a really large bond portfolio of a lot of securities is really time-consuming to manage duration or manage exposures. So we've seen that in some cases, these institutions are giving their bond portfolio to an ETF manager and then holding on to the ETF. So it saves them a lot of work. You've also seen that ETFs are being used to do tactical asset allocation. You can use them as hedges. So there's many different ways. I mean, you can kind of put them into short-term, so equitizing cash. You can put them into tactical, as you heard from Pav, where you hear news, something happens, or you want to make an adjustment, and then long-term. So surprisingly, I mean, if you go back to Mr. Bogle, he often would have you believe that ETFs are only used short-term, but what you find is probably about 60% of institutions hold ETFs for more than 2 years. So they do really work short-term, kind of tactically would be a 6-month period, and then longer term, which most people don't realize because, as you said, they're often in the press being dinged as people only hold them for a few days or hours, which clearly is only showing you a really small portion of how they're used.
Yeah. And Christine, would you agree with this? Do you think they're could be a longer term product?
Yeah, definitely. Although, especially as you were kind of alluding to different environments as to when ETFs will really prove their worth, when you do see a lot of volatility, an ETF vehicle is there to allow you to get your money out or switch into other asset classes very easily, especially if, at the moment there's a very low levels of volatility, but I think when that sentiment maybe suddenly changes, you will see clients definitely benefiting the most from ETFs. And as well, I think if the ETF industry has had bad press in saying that, they've only been popular while the markets have been rising, there is just so much innovation in the industry now to allow for exposures that will actually benefit when there is higher volatility and more sideways or choppy market.
Okay, so Pav, tell me how you do your due diligence then.
Yeah, absolutely. So it's an area we've looked at quite closely along with the investment management community. For us, we define this 5-step process, which really applies to any investment product. First and foremost, you have to look at the underlying exposure. So what's the index that you're actually buying? How is it composed? What does the portfolio look like? What tilts are there? How's the portfolio weighted? So we talked about smart beta strategies. It's interesting and important to understand how they might differ to market cap indices. And what the portfolio tilts look like in comparison. I guess once you've covered the underlying exposure, you then move on to the product structures. So as Christine's already touched on, counterparty risks are very important to bear in mind. So ETFs are either structured physically or they're swap backed. Obviously, if they're physically backed and they engage in stock lending, which some providers do, then it's important to see whether or not collateral is being posted. And again, in the swap back scenario, again, there's a counterparty risk. Very important to clarify whether or not the swap counterparty is posting collateral. If so, and it's fully collateralized, then those risks are being mitigated. Then moving beyond the product structure, you have to look at factors like costs, so total costs. There's both your management fees as well as your portfolio transaction costs and execution costs. And there's also, of course, liquidity. So how easy it is to trade a product, but more importantly, how liquid the underlying markets themselves are. And of course, finally, tax and legal implications. But from our perspective, we understand suitability requirements do pose challenges, for a lot of advisors and wealth managers. So a thorough and formulaic process in due diligence should help to create an efficient process when comparing ETFs.
Yeah. Now, we've recently seen the FCA's asset management market study, and I think ETFs have actually done well out of this when it comes to transparency and fees. I mean, Deborah, what are your thoughts on this?
Yeah, I definitely think that they have been very transparent on what they do and how they do things. And I think maybe just to add to what was just said is a really important thing to remember is ETFs are UCITS funds. So what ETFs do are regulated under the UCITS guidelines, and they're the same thing that other UCITS funds are doing. So securities lending is not something only done by ETFs, nor is using derivatives. And quite often, because ETFs have always opened their kimono and say, we do this, this is how we do it, people think that ETFs are being done differently than all other types of funds, which clearly isn't the case. So I would say that the FCA, I think, has found that ETFs being transparent, being cost efficient, actually are ahead of many of the active funds that tend not to be so transparent on what they're doing and how they're doing it. Partially because regulations, when you're active, only require typically that you provide transparency on your portfolio on a quarterly basis. So ETFs are telling you every day what's happening, which is one of the benefits people find from them.
Yeah. Can you see a boost to the industry off the back of this, Christine?
Well, yes, obviously when both MiFID and the FCA studies kind of become implemented, I think ETFs are already well positioned. So as Deborah was saying, just the further transparency that they usually give over and above other mutual funds, as well as just always being associated with being good value for money, which was a major focus of the FCA study. So yeah, I think at BMO we definitely welcome these studies.
Okay, well, after the FCA paper came out, there was they put also out a paper, I think it was about 2 weeks after, you explained to me, on platforms and a consultation period on this. What sort of issues would you say were raised by this, Deborah?
Well, I think one of the challenges that you find is many of the mutual fund platforms, when people buy and sell mutual funds, you don't need connectivity to an exchange. And because ETFs are traded like stocks, a number of the mutual fund platforms today do not have that connectivity. And so some of them do not offer the ability to use ETFs, which clearly RDR was about providing a level playing field and having financial advisors look at the whole of the market. And so I think that it is highlighting some of the challenges on some of the platforms. I think some platforms just feel there's no demand from IFAs and use that as the reason they don't offer them. I think the other thing that I've seen is quite often most ETFs track an index, so you would think they were tracker funds. But quite often the word tracker funds is used only to indicate mutual funds that track indices and not ETFs. So when you go to platforms, often you'll find you don't see ETFs when you search for the best FTSE tracker or whatever. And I think the other is probably, if they do offer ETFs, are they offering all products? And how are they offering them? And model portfolios, are they embracing products from all providers? So I think having that transparency on cost, the level playing field extended, is going to be very beneficial as they go through and do this, what is the current landscape and how it might be improved. So I see it as a very good opportunity for ETFs.
Good. And Pav, you're nodding along. And how do you see ETFs changing behaviour in markets?
Yeah, absolutely. And, sort of as has already been implied, ETFs are essentially just access vehicles. So a lot of the time, the press talk about ETFs influencing markets, but it's really asset allocation and what investors want to allocate that's really driving investment behaviours. All ETFs have done is provide access to different types of market, and I think that's an important point to make. But what we've seen with developments and different types of investment strategies is that ETFs have essentially democratized the investment landscape. It's something Deborah referred to earlier on. I think this is the key point. What they've done is they've opened up access to hard-to-reach markets, or markets previously that were dominated by different types of investment products, and they've provided choice, and they've done this in a low-cost manner. So when we think about ETFs and how they've changed behaviour, this shift towards passive investing and ETFs as the chosen vehicle to access passive strategies will continue to grow in the coming years.
Yeah, well, it does seem like the industry press have liked to pitch active versus passive into this big almost war, but Christine, you actually offer both, so do you think there's an advantage to managers being able to offer both?
Yeah, definitely. If anything, it's this focus on the wrapper, which sometimes is a little bit unnecessary, but at BMO Global Asset Management, if we offer the full range of active and passive, and even kind of the in-between as well, kind of factor-based strategies, we see them all as solutions, and if anything, we're just getting to know and understand our clients better because we're product or wrapper agnostic, and we just want to deliver the type of investment solution that they need, and at whatever cost is kind of justifiable for that particular strategy. Another kind of benefit I have found since working at BMO Global Asset Management is that there are some overlap and kind of synergies between some previously actively run teams. So like our systematic strategy team, who have been involved for a long time in, say, building their own proprietary indices. You can see how then a lot of those portfolio managers can then start to track an externally provided index, like from one of the main index providers like MSCI, very easily and in a very similar way as to how they would have tracked their own proprietary index.
Yeah. So now let's move on to some of the trends we're seeing in the industry. And Deborah, what would you say is the impact of robos using ETFs?
That's really an interesting space because I think in some ways robos are a little bit like using Wikipedia, because for many investors, especially as they start to look at retiring, they haven't really felt comfortable asking questions about financial products. And so many will go to a robo to play around, look at asset allocation, become familiar with terms and products, because clearly RDR is relatively new, so many retail investors aren't familiar with ETFs and asset allocation. So for many, it's a way to become informed, and what they want to do is then ask someone. And typically, you hate to tell your friends and family you don't know things, so you want to be informed, speak to your financial advisor. And so what we're tending to find is there's a lot of robos, but the ones that have been the most popular tend to be the ones that combine the robo with the ability to speak to someone, so this hybrid model. What we also see is the robos are being used by, on average, people who are 47 years old. So it's not just a millennial product. So many think it's something that only younger children or people in their 20s or early 30s are using. But the reality is, if you look at certain markets like the US, where every day 10,000 people are turning 65 years old, you're seeing that many older people are going to the robo to do that homework. And same here, where you can take your lump sum pension if you want to. I think many are using the robos to become more informed.
Yeah. And Pab, there's also a trend in people using ETFs to build a model portfolio. I mean, what's your thoughts on that?
Yeah, it's a fascinating area. So as Christine said, it's been a real growth area in terms of ETF distribution, in terms of the model portfolio services. I mean, it's very interesting. What we've seen is a lot of sort of wealth managers look at ways in which they can improve efficiency within their own businesses. Of course, they're being squeezed in terms of their own margins, and they've got a very diverse client base. So what model portfolios have done is they've offered a solution to wealth managers in terms of constructing portfolios in an efficient manner. As Debbie said, asset allocation is a very important part of generating alpha. What MPS or model portfolio services do is they construct multi-asset portfolios, but by using ETFs you can do that in a low-cost manner whilst building core building blocks for asset allocation. So we expect growth in ETF usage within model portfolios to grow quite rapidly in the coming years. But of course, it's important to point out that they can be used alongside active funds as well, as Christine's already said. So we're seeing more and more wealth managers have blended model portfolios, as well as purely passive model portfolios, as well as potentially purely active model portfolios. And that's a really good development because it gives investors a lot of choice. So we expect ETF usage to increase as model portfolio assets increase within wealth managers.
Yeah. And looking at concerns when it comes to ETFs, and Christine, you flagged up the fact that a lot of clients come to you and say that there isn't really enough data to research the ETFs that they're buying into, or they don't know how reliable the data is. You know, what's the problem with this?
Well, if anything, and myself and Pav, as part of the ETF forum, have received a lot of feedback from IFAs in particular, who just are trying to find, well, what is the best independent source of ETF information. And you know, I kind of don't envy them in the sheer size of, or the sheer size of the market, or the sheer number of ETFs that are available. So there are a lot more sources becoming available, which is great, and ETF GI being one of them is obviously improving and expanding that source of information for IFAs.
Yeah, but do you think there is a need for more education out there?
Yeah, and we've seen it with the ETF forum, in that there is just a growing attendance rate at these purely educational seminars. We don't talk about product at all. So it is just a case that they're able to ask the questions that they wouldn't normally be able to, or at least they know that they're getting a very unbiased objective answer to some of those questions, instead of just relying on one sole ETF provider. So there needs to be kind of more acknowledgement or awareness of those types of resources. So I think that is happening slowly but surely.
And Deborah, are you seeing a lot of misunderstanding out there surrounding ETFs, and what's the sort of myths that are out there that you can debunk?
I think some of the big challenges are because the internet makes it so easy to find information, but you're never sure who it's actually written for, right? So you'll find something saying, you know, this is the best ETF for exposure to X, but it might be written by someone who's based in the US and really looking only at products there, which probably aren't very tax efficient for UK retail investors or IFAs. So I would definitely say that as the types of ETFs expand, benchmarks change, currency heads, there's so many things and innovations happening that many people, the big challenge is until you actually do your first trade, you're not even sure of all the questions. So as you start to do your first trade, you start asking questions about how can I put an order in, when should I put an order in, who should I trade with. So once that first trade is done, the education level rises a lot, but until you actually start to do it, it's kind of like if someone said to you, could you bake a cake, you'd be like, yeah, sure. But it's not until you actually go and do it that you really realize all of the nuances, especially like if you come here from the US and you use measuring things as opposed to weights. Things are different in different markets. So I think that's kind of a good analogy.
Yeah. And there is also a lot of headlines out there, especially in the FT, questioning whether ETFs have reached peak passive territory. Pav, what would you say to that?
Yeah, it's a controversial area. There's lots of opinions on it. I mean, from our perspective, you know, we don't necessarily think there is, you know, such a thing as, you know, peak passive territory. And we've heard a number of active managers actually allude to the fact that, you know, passive investing is going to continue to increase. You know, and it's going to eat into, you know, the active market share. I mean, from our perspective, you know, ETFs are just access vehicles, and investment behaviours will be driven, you know, more and more by asset allocation. And ETFs, if they're the chosen vehicle for a given asset class or exposure, then you know you might see, you know, further increases. But as Deborah said, development in this space is so rapid. So smart beta strategies are this growing area that we expect to see assets grow quite dramatically over the next, you know, 3 to 5 years. So that's an example of where we see further penetration in the investment management industry in terms of, you know, passive assets.
And Christine, what sort of trends moving forwards are you seeing in this industry?
Well, very similar in terms of just growth and seeing more drivers of growth, both in the types of users, as I alluded to earlier, but also in terms of, well, if, for example, there's new innovative solutions that are kind of more akin to what, say, IFAs or private wealth managers are used to using, but have typically charged higher fees for. Now they're switching into using ETFs, and so that will drive a lot of growth, I think.
Yeah. Well, unfortunately, we are almost out of time, so if I can just get you all to give our final thoughts, what you'd like our viewers to take away. So, Deborah, if you'd like to start.
Yeah, I think, you know, it's important to keep in perspective that today ETFs are like 4% of mutual fund assets in Europe, so there's a lot it can grow, and so clearly I don't see it anywhere near being at peak. So I think the future's bright, and I would suggest if you have questions, there's never a dumb question. Please ask so that you are comfortable when you go and use ETFs.
Yeah. And Pav?
Yeah, absolutely. Just following that, I'd say if you have any questions, do ring up the ETF providers themselves. We've got large distribution teams who are always on hand to help. From our perspective, we expect further development across the industry, whether it's smart beta strategies or currency hedge strategies. It's really important, for advisors and wealth managers to understand that ETFs are just access vehicles, and they can play, a really important part in multi-asset portfolio construction.
Yeah, and Christine.
Just further feedback as well is required, and more open discussion about the ETF industry, and hopefully the ETF providers themselves, us included, are providing enough information on our websites, but it's always very helpful just to hear back as to how we can improve that going forward.
Super, thank you. Well, do stay with us here on Asset TV as we've got information coming up on how you can put this masterclass towards your structured CPD, and all that remains is to thank our expert panel today. So we had Christine Cantrell, who's the Sales Director of ETFs, BMO Global Asset Management. Also Pav Sharma, Associate Director of UK Sales and ETF Securities, and Deborah Furr, Managing Partner of ETF GI. So to all of you, thanks for being with us today. And to you, thanks for watching, and see you next time. By the end of this video, you'll be able to understand and describe the advantages of investing in ETFs, how advisors can use ETFs in their portfolios, and in what market conditions ETFs thrive and struggle. Please complete the reflective statement to validate your CPD.